Man, this market, huh? It's
Yeah.
rough out there. The S&P 500, I mean, it's officially, we can say it, a bear market.
Yeah, more than 20% down.
More than 20%. And the NASDAQ, well, I mean, it's even worse, right?
Similar story, yeah, at least.
A lot of our listeners, I'm sure, are wondering, and frankly, it's what we wanted to talk about today. Should we be selling our stocks?
Well, it's a natural reaction, right?
Yeah.
When we see those numbers in our portfolios going down, down, down,
Yeah.
we want to, protect what we've built.
Right. And a lot of the time, the advice is, just buy and hold, write it out.
Yeah, the classic buy and hold.
Buy and hold.
For the classic.
But we're going to deep dive today into some situations where, maybe selling in a bear market is the right move, at least according to the Motley Fool.
Right.
And when it's not. So we're using the Motley Fool as kind of our jumping off point today.
Exactly.
And hopefully by the end of this, listeners will have some actionable insights they can actually use to deal with this, mess.
Right.
So what's the first, when should you sell, according to the Motley Fool?
Well, they talk about this idea of almost using the bear market as like a stress test.
Okay.
For the reasons that you bought that stock in the first place.
Mm-hmm.
So if those fundamental reasons are no longer there.
Like, what do you mean?
So, you're not just selling because the price is down, right?
Because everything's down right now.
Everything's down.
Mm-hmm.
But if the core reasons that you bought it, the core thesis, as they say, the investment thesis is broken,
Okay.
then it's a signal to at least reassess.
Okay.
So they give a couple of examples to illustrate this point. Right?
Yeah, I'd love to hear them.
So imagine you invested in a company, and the reason you invested is that they were the clear leader in their sector. Nobody was even close.
Right.
And now suddenly there's a new competitor, and they are gaining market share like crazy.
Mm.
The original company, their growth trajectory, it's not looking so good. Their profitability's down. And all of a sudden, that dominant market share, the whole reason you bought it, it's gone.
Right. So the competitive landscape has totally changed.
Exactly. So, that's one scenario. Another example they give is, let's say you bought a company because they were just financially, rock solid, right?
Okay.
Their balance sheet was pristine. They had very little debt, just cash flow, consistent, reliable.
Yeah.
And then something happens, whether it's some bad decisions, some bad strategic decisions, or, something unforeseen.
Mm-hmm.
And they take on a huge amount of debt. And that completely changes, the risk profile. It's not the same company anymore.
So the point here isn't just that the market is down.
Right.
It's about, has the company itself changed
Yes.
in ways that mean your original thesis is no longer valid?
Exactly. Yeah. You got to look past the overall market sentiment and look at the specifics of that business.
Got it. What's the second reason to think about selling?
Well, this one's a little more straightforward and a little more personal, potentially.
Yeah.
It's when you need the money.
Well, yeah, I mean, I guess if you're running out of money,
Right.
you've got to sell stuff.
Right. But the article points out that ideally any money that you think you're going to need in the next, 3 to 5 years
Mm-hmm.
shouldn't be in the stock market in the first place.
Right, because it's too volatile.
Because it can be volatile. But, sometimes life happens. You might lose your job. You might have unexpected medical expenses.
Right.
Or, just with inflation, maybe it's just costing you more to live your life.
Yeah.
And in those situations, you might not have a choice. You might have to sell some of your stocks, even if it's at a loss. And, it's not ideal, but sometimes you got to prioritize your own financial well-being.
Right.
And just take care of yourself and your family.
Okay, so that's pretty straightforward.
Yeah.
Sometimes you got to pay the bills.
Right.
What's the third reason?
The third one, it's a little more of a strategic kind of portfolio management technique.
Okay.
It's called rebalancing.
Rebalancing.
And essentially, it's the idea of adjusting your asset allocation.
Okay.
So that's your mix of stocks and other investments like bonds.
Right.
And the idea is to maintain your desired level of risk.
Okay.
And the article mentions this thing called the Rule of 110.
Rule of 110.
Have you heard of this?
Vaguely, yeah.
It's this rule of thumb. It says, subtract your age from 110, and the answer that you get, that's the percentage of your portfolio you should have in stocks.
Okay.
And then the rest would be in, something less risky.
Okay.
So like if you're 40 years old, 110 minus 40, that's 70.
70.
So 70% stocks.
Okay, got it. So then how does a bear market mess this up?
Well, let's imagine you started with $100,000
Mm-hmm.
and you're 40, you're following the rules, so you have $70,000 in stocks, $30,000 in bonds, perfect 70-30 split.
Yep.
And now the bear market comes along and stocks go down 25%.
Oh, no.
Which, unfortunately can happen.
Yeah.
So now your stocks are worth, $52,500.
Yeah.
Your bonds, they're more stable. They stay around $30,000.
Okay, so that ratio is way off now.
Right. And the total portfolio is only worth $82,500 now.
Ouch.
Yeah. So your stocks now, they only represent about 64%. Your bonds are now 36%. So to get back to your 70-30, what do?
Well, you got to sell some bonds.
You sell some bonds.
And buy stocks.
Exactly. Sell the thing that's done better, relatively speaking.
Right.
And buy more of the thing that's gone down.
Okay, so it's kind of like you're selling high and buying low.
Yeah, in a sense.
Yeah.
It says, you're buying low.
Yeah.
So you're rebalancing.
So rebalancing is just a way to kind of stick to your risk tolerance.
Exactly. Because the bear market can kind of sneakily make your portfolio riskier.
Right.
Just by, those stock values dropping.
Okay, that makes sense.
So rebalancing is just kind of a, disciplined way to stay on track.
You're disciplined. Okay, so we've talked about when to sell.
Right.
3 reasons to sell, at least potentially.
Yeah.
What does the Motley Fool say not to do?
Well, the biggest mistake, they say, and this is the most common one, and probably the one that hurts people the most, is selling just because the price is down.
Yeah, just panic.
Panicking, yeah.
I'm down 20%, I got to get out.
Exactly.
Yeah.
And they address this pretty directly in the article. They say, look, if the price is down because there's actually something wrong with the company itself, like we were just talking about.
Right.
Then maybe selling makes sense. But if you're selling just because the market is down, then you're basically just locking in those losses.
Right.
And you might even miss out on a recovery.
I had a friend who sold almost everything at the bottom in March 2020.
Why?
When the pandemic first hit, and then, of course, everything went
Oh, wow.
straight up after that, and he really regretted that.
Yeah, I can imagine.
He really regretted that.
Yeah, buy low, sell high, right?
Yeah.
It's the classic advice, and it's the exact opposite of what people do when they panic sell.
Yeah. Yeah.
And the article reminds us that, back in the financial crisis in 2008, 2009, people who sold everything, they missed out on a huge bull market that came after that.
Right.
So the point is, unless there's a reason, like a really valid reason to sell,
Right.
you want to hold on. Because market volatility is just part of the game.
It's just part of the game. Don't panic.
Yeah.
Okay, what's the other thing they say not to do?
Well, the other thing is to be careful about selling primarily for tax loss harvesting.
Tax loss harvesting.
Now, they do say in the article that it can be a helpful strategy.
Right.
It can be kind of a silver lining.
Okay.
If you're already selling for some other reason, one of the good reasons we talk about.
Right.
But so just to make sure we're all on the same page, what is tax loss harvesting?
Yeah, what is it?
Basically, you sell an investment that's down, and you use that loss to offset other gains that you might have.
Okay.
So let's say you sold something earlier this year for a $3,000 profit, right?
Mm-hmm.
But now you're selling something else and you're losing $2,000 on it.
Yeah.
Well, you can use that loss to reduce your taxable gain to just $1,000.
Okay.
And, if your losses are even bigger than your gains, you can usually deduct up to $3,000 of those losses from your regular income.
Okay.
So, yeah, there are definitely some potential tax benefits.
Yeah.
But the Motley Fool, they say, look, those tax benefits should be secondary.
Right.
Don't let the tail wag the dog.
Don't let the tail wag the dog.
If you still believe in the company
Mm-hmm.
and you would otherwise hold it, don't just sell it to save a little bit on taxes.
Yeah, because you might miss out on that stock, skyrocketing next year.
Exactly. You don't want to sell a future winner just to get a small tax break today.
That makes sense. Yeah. Okay, so just to sum up everything we've talked about today.
Yeah.
3 potential reasons to sell in a bear market, according to the Motley Fool.
Right.
1, your investment thesis is broken. Something about the company's fundamentally changed. 2, you really need the money for some reason.
Right.
And 3, you're rebalancing your portfolio.
Exactly.
And on the flip side, 2 things not to do.
Yep.
Don't just sell because the price is down.
Right.
Don't panic.
Don't panic.
And don't just sell for the tax break.
Exactly.
Yeah.
Unless you were already planning to sell anyway.
Yeah.
Yeah.
So I guess the overall message is for those good companies,
Yeah.
the ones you still believe in,
Right.
Stay the course.
Yeah.
Buy and hold.
Buy and hold.
The bear markets are scary, but,
Yeah.
they end eventually.
They always end. And, a good business is a good business.
A good business is a good business.
Yeah.
Okay, well, I think we've given everyone a lot to think about.
Yeah, we've covered a lot of ground.
As you're thinking about your own portfolio
Mm-hmm.
here in this bear market,
Yeah.
I think the most important question is this. For each stock that you own, has the reason you bought it changed?
Good question.
Or are you just reacting to the market? And honestly, answering that,
Right.
is going to help you make the right decision for the long term.
I think so.
So think about that.
Yeah.
That's all for us today.
Until next time.
See you next time.